the reason that there are limits on who can do it and how much you can save lets you know that it is a really good deal for
Yeah.
people to take advantage of. All right, get on with it. All right, everybody, welcome back to our latest installment of Bugle Notes. I am Stephen Weitzel, managing partner here at Reveille Wealth Management, joined by my partner Chad Smith and our good friend Nick Westmoreland, partner at ERISA Services. So ERISA Services is a local TPA firm, and Nick's role there is to build and foster relationships with financial advisors like us and other CPAs. And we partnered together to identify what the best retirement plan solutions are for our business owner clients, for our corporate clients. Nick has over 15 years worth of experience in customizing qualified retirement plans for small to medium-sized businesses and organizations. His passion lies in getting to know his clients, the culture of these companies, and their retirement plan goals. Every client that we serve is unique. And so customizing and finding the right fit, the right tools to bring out that enterprise's objectives is the challenge that Nick really enjoys the most. So really specializing in 401ks, maybe 403b, plan design, administration, cash balance plans, other defined benefit plans, 316 fiduciary services. That is the focus of ERISA Services. So, Nick, thank you so much for joining us here today.
Glad to be here. Appreciate you guys.
So, as we said, we are going to embrace this very meaty topic that everybody is quite interested in. That is tax shelter for business owners or for corporations, talking about retirement plans. So, one of the things that I want us to kick off talking about here is how we can go about helping business owners get the largest amount of tax shelter that they possibly can. Um, and some of this is going to pick up from a discussion that we had back a number of months ago when we did a workshop for some of our clients locally and others here in the South Atlanta area, where we were talking about, we had a workshop to cover how somebody could look to maximize the level of tax shelter that they can. Um, and one of the things that the CPAs are talking about a lot since the 2017 Tax Cuts and Jobs Act that just got extended here with the big, beautiful bill is this qualified business income deduction, this QBI deduction. Um,
hmm
and we spent time in that workshop going over how CPAs are looking to help their clients, their business owner clients with S Corps or other pass through entities, help them maximize to get that Section 199A deduction. And typically, what it translates to is they end up having to take a larger salary, which is kind of counter to the way a lot of business owners have typically tried to do things, right? They've tried to take a small salary, take more in distribution to save themselves some payroll taxes along the way. But now, in order to get this larger deduction, they've got to take additional W 2. But what that really allows for them is to increase the amount of money that they can shelter into some of these different retirement plans. Let's talk about that a little bit. So talk to us a little bit, Nick, about how the level of W-2 earnings that a business owner receives translates into the amount of tax shelter that they're allowed to make.
Yeah, for sure. Um, so if you're, when we go to run these illustrations for your clients, we're, typically targeting the business owner or business owners to receive as much of that employer contribution as possible. And so when we do that, we have to run non-discrimination testing, and the higher salary that the business owners are taking, the lower percentage of pay that they need to get to a certain contribution threshold. So if we're trying to get them maxed out at, the yearly limit for this year, they they need a lower percentage of pay in the testing when their W-2 or their plan compensation is higher. And conversely, when it's lower, and you see that a lot of times with, S corp owners where, their CPA may have them well below the taxable wage base. Um, we try to educate that, hey, if your W-2 is, 120, 100,000 or lower, we're going to need a much greater percentage of your pay to get you to, that maxed out number that you're looking for. And what that does is it balloons your staff cost, right? So there is an advantage to having a higher W-2, a higher plan level plan compensation by keeping your staff costs as low as possible. Um, but we're generally not advocating for that. We're simply trying to educate and say, hey, this is the relationship. Please work with your CPA to see what works for you.
Yeah, I think some of it, comes down to most business owners are looking for the largest amount of tax shelter that they can get, but they may have other corporate objectives too, in terms of retention from an employee perspective. And so not everybody is just looking for maximum tax shelter and minimizing contributions for staff. But if we can look at just a couple of examples here, and this is one that we examined in our tax shelter workshop, that we saw. Here's a hypothetical company where the owner was paying himself $120,000 a year salary. Um, he's got, some staff, a guy who's a machinist who he pays a higher W-2 wage than he pays himself, a manager that he compensates pretty well, some techs, and then an office admin. Um, and because there isn't a real disparity in terms of what he is paying himself W-2 wise and his staff, and certainly considering the fact that he isn't substantially older than some of his staff, then he would still get a pretty meaningful amount of contributions across all of the plans that they were trying to fund. But once his W-2 goes up, right? In this case, we show it from 120,000 up to 240,000, that it would have been bumped up, doubled in order to help him maximize his qualified business income deduction. His CPA would help him arrive at that number. Now, all of a sudden, there is more of a disparity, right, between what he's paying himself W-2 versus his staff. And all of a sudden, the level of contributions that he is receiving across all of the plans he's looking to shelter in goes from 77%, which is still really good, all the way up to about 86.
Well, I think it's important to note in this example that that level of salary translating into a higher contribution amount allowed for the business owner. Also, it assumes that you've got the other components at work in this plan design structure, right? Not just 401k, but also profit sharing and also this cash balance plan that we can talk about a bit more later. But it translates all the way through in terms of the calculations for all the other components that you can bolt onto this plan, right? Which we get into more creative plan design
Sure.
structures.
Well, I mean, let's talk about it right now, because a lot of business owners out there, they've set up 401ks for themselves. Everybody knows that they need one, they want to be able to save money for retirement. They want their employees to be able to contribute to, for retirement. But where this is kind of table stakes, the 401k plan now, and maybe folks are using the profit sharing component, but those that
Right.
are doing really, really well and they want to be able to save more, that's when you integrate something like that cash balance plan to further enhance the level of savings and tax shelter that they're able to enjoy in a given year. But let's talk about how do we cobble these tools together in a customized fashion for business owners?
Absolutely, Stephen. So, first you guys are always happy to do this, as are we, to run custom illustrations, for any prospective client. So if CPA reaches out and it's like, hey, I have a company that's doing well, they're thinking about doing a retirement plan. We generally try to collect a census file showing a snapshot of 1 year. Ideally, the year you're in would be the most meaningful. And we just import that into our software, and we'll work on customizing illustrations, showing different benefit levels for the owners. And if they're a good candidate, we could include cash balance as part of that. And Stephen, you hit on something really important that, with both a profit sharing contributions or a cash balance, defined benefit type of plan, that's going to lead to very meaningful employer contributions for their team members, their employees, right? So it's something that, the business owner can feel good about and proud about, that, hey, not only are we offering a 401k plan, but if we're doing profit sharing on top of that, and maybe even cash balance, um, you know, we're able to take care of multiple goals there, take care of the employees, but also maximize tax savings for the business owner.
And I think what we've seen a lot, certainly on the other side of COVID, where labor force participation went down, the war for talent, went through the roof.
Mm-hmm.
And now you had a lot of folks, a lot of employees in these companies, they they're trying to take care of their families. And if they know they have the opportunity to take a job at a competitor or somewhere else down the road and they can make 15% more by changing jobs, they're going to do it. And so a lot of businesses have struggled with turnover, and without the ability to, or the determination that they're not just going to give everybody a 15% raise, 18% raise to keep them on. Companies are wanting to know, how can we be smart with our corporate resources and maybe put some golden handcuffs around folks, show them we value them, we want to give them some additional benefit, but also that if those folks do choose to leave and go elsewhere, then maybe they're not going to realize the benefit of what we provided. And so that's where adding on things like the profit sharing, the cash balance, uh, that has a vesting schedule associated with it. All of a sudden, now somebody leaves before they're vested in that, and they're leaving those benefits behind. Um, and the other piece of it, for certainly if it's a small business, um, that contributions that the company's making into the profit sharing plan, into the cash balance plan on behalf of their staff, that it's really a more tax efficient way for them to get compensation down to these employees. Can we talk about that, Nick?
Yeah, absolutely. It just points to the how important it is that if you're a business owner seeking these solutions, to get the right kind of help, the right kind of expertise, somebody who's willing to spend that time with you on the front end and explain all your options, right? If you just immediately go to, online 401k in a box, who's just going to put you in a very plain plan design, you're not going to get access to this type of information. And you're spot on. A lot of times we'll have business owners say, hey, I bonus my employees, 10% of pay each year. My worry is that if I move all of that 10% to a qualified retirement plan, and now they're getting less cash in hand, I'm worrying I'm going to, frustrate some of my team members. And so we'll do consulting around that. What are the pros and cons of doing it inside the retirement plan? Maybe taking baby steps to doing that, so that you're not doing it all at once, so that there's education and strategy. I know you guys are amazing at that. How do we educate our employees so that they understand this benefit that we're working so hard to build for them? And it's really cool when you guys know this when you work with a client for multiple years and their employees look back on this retirement benefit that has built up, just the goodwill that it builds towards the employer, knowing that, hey, I'm going to have something at retirement that's going to be meaningful.
Well, one thing that might be good for us to do, because we kind of getting in a little bit of the weeds, and I know we want to get into the weeds a bit more, but to kind of back up for our broader audience and maybe just hit on the highlights of the various plans that are available for employers or plan sponsors to consider. Because we all know in working with business owners on a daily basis, so many business owners are super smart people and 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 yet at the same time they're so involved in their business and just the busyness of running it that they don't really understand a lot of the stuff that we take for granted and think that maybe they do understand, they don't. And so as we get into some of the nuances of plan design and the kind of contributions that can go in and the pros and cons of all that, it's often the case that that they need guidance on that very much so. So for just that, just briefly to touch on for our audience broadly, let's just dive into just high level. Like for example, a lot of small business owners, they start off and they've got a few employees and they think I need to offer something to my employees, but the idea of setting up a 401(k) plan is very, kind of overwhelming for them. So they think, I'm just going to do this real easy thing like a simple IRA or potentially a SEP IRA. And then they kind of get in that, and then that's just kind of the thing that they have. I had a business owner recently who started working with it. He's had a simple IRA plan in place for years. They've now come on board with us, and they're a perfect example of they should be doing all of the things that we've talked about here, 401(k), profit sharing, even cash balance, but didn't even realize that it was available and what it really entailed. So I think there's a lot of folks who just they get on they get on the wheel and they just are running their business and don't pause maybe enough to kind of look at all the options. So what if we just hit on the highlights of those and we can kind of compare and contrast a little bit?
Yeah, and I would say to that end, I think that most business owners they're focused on running their business, and
Right.
the time that they think about their retirement plan is probably when they decide that they think they want to set one up, and then the only other times that they think about it is if they have a problem, right?
Hmm.
I've always said that one of our missions is to try to uh, we want the retirement plans that we're involved with advising on and managing to be like the officials in a football game, that they're there doing their job, but if they make themselves part of the game, it's for the wrong reasons, right?
Hmm.
And if a lot of this stuff starts to take a lot of time from a business owner, it's probably because something has gone wrong somewhere. And
Right.
so, we want people to have more turnkey solutions where they can keep their head down, run their business. But I do think it's important for people to be educated, to your point, Chad, on what all is available out there, because a lot of times we see that people just take the path of least resistance, and whether that is a simple IRA, as you mentioned, right? Nick, I don't know you want to chime in on this, but a simple IRA is something that is not going to require really any administration. Um, and as it is simple to set up. There's one form, right, for them to do. Um, and but the contribution threshold, what they can put in every year, it's more than just funding a traditional IRA, but it's less than something like a SEP IRA or a 401(k).
That's exactly right. And I mean, the simple IRAs, they are individual accounts, so can be a great solution for business owners wanting to kind of dip their toe into having a retirement plan, and are okay with those lower limits. SEPs can be great as well. SEP is employer contributions only. That you're generally limited to 20 up to 25% of your eligible W-2. potential downsides of a SEP compared to a 401k is that if you're one of those S corp business owners and you have a low W-2, doing a SEP, is not going to give you a very high contribution level. So that, those are the type of consulting we would do with them. And sometimes a SEP is a better fit if they're taking a healthy level W-2 and their employees haven't been with them very long. You can have an eligibility of up to 3 years with a SEP. So sometimes that makes perfect sense. And the same
Do you
thing
think
with
SEP because, as you hit on, where the simple would allow for employees to make salary deferral, but the SEP is employer contribution only? SEP is something that we're much more likely to see with a company that is smaller, has fewer employees.
Absolutely. And a lot of times their CPA can do the SEP filing for them each year. So it's like you said, with SEPs, it's minimal administration, something you look at once a year, whether you want to fund it or not. So it can definitely be a good solution.
But both
So
of
so
those, right, and as simple as they are, right, um, from an admin standpoint, um, some of the cons with those versus going with a 401k, which I think has certainly entered the lexicon of Americans these days, right? Everybody, people have had 401k since the 80s. But once you get into an employer sponsored plan like a 401k, the contribution thresholds for an employee to save their own money is higher than what it would be in a simple, but you have the ability to do things like borrow from a 401k that you don't have the privilege of doing with a simple or a SEP, right?
That's right. And I think you hit on the biggest thing in my mind there is that employees I can identify and understand what a 401k plan is. So, you know, so it has more awareness from your employees. Another potential downside for simple IRAs is that depending on what institution where you put your money there, you could be sending multiple checks for multiple employees each pay period, whereas a 401k can sometimes offer more streamlined administration by just having one contribution file each pay period for everybody. So if you're an
right.
HR manager or payroll specialist, sometimes 401k can actually be easier than a SEP.
So small business, right? Maybe five, six people or less, uh, you know, maybe a SEP, possible simple up to maybe 10, 12 employees. It's not too onerous. The simple wouldn't be uh, administratively to maintain. But as you start to get over and above that, now it's cutting into somebody's time to have a simple where they're having to send all these individual checks, right? And Chad, we have those, right? We have
Yep. Yep.
those checks that come in every week for the simple plans that our business owners have. But they kind of fit that criteria of smaller in number. Um, but once you get over a certain threshold, then the administrative burden sometimes is eased by doing the conversion to the 401k.
That's
Certainly.
right. And thanks to Secure Act 2.0, which was passed last year, you can now convert simple IRAs to 401k mid-year, where historically you had to wait until the year's over with. So we saw a record number of those this year, and I think we'll continue to see that. And just give business owners more flexibility there for sure.
So let's just touch on that really quickly. What are kind of the main caveats out there of I've got a simple, I'd really like to go to the 401k, uh, and I'd like to do it. I don't want to have to do it right at the end of the year for some reason. Although going into the fourth quarter, it's always, kind of appropriate. You terminate that simple on 12/31, start the 401k on 1/1. But what are the caveats? If I want to make that shift, what do I have to ensure with my plan design on the 401k to make that happen?
When you're looking at converting to a 401k plan mid-year, there's a couple things you got to keep in mind. One, if you're going to change over to a safe harbor match 401k, which is the natural fit for those that are doing simple IRAs currently, that plan has to be up and running for 3 full months that first year. So, um, so for most calendar year tax years, you got to be up and running by October 1st. So you got to have that decision made if you're wanting to convert mid-year. Otherwise, you're waiting till January 1st. And then second, if you're doing it mid-year, you don't want to lapse in employee contributions, meaning that you want to have your safe harbor match 401k plan set up so that when you're stopping your simple IRA contributions, you're immediately starting the safe harbor match 401k. So, and that's of course something that you and us together, we take clients through that and make sure they're, understanding all of that.
Now let me
So,
ask this, Nick. The simples, are there's no Roth provision for a simple. Is that correct?
I believe that's correct. So we don't administer simples, but I believe I think you're right. It's all
yeah,
pre-tax.
It's all
that's correct.
pre-tax. We know
All
that
pre-tax.
for the SEPs, of course, employer contributions, all pre-tax. Um, so again, one of the benefits moving to the 401k, little higher salary deferral that somebody can put in, ability to borrow, but the plan design within the 401k can allow for employees to make Roth contributions, after tax contributions. Now, all of the employer contributions, whether it's a non-elective contribution or a safe harbor match or any other type of matching contribution, that is all still going to be pre-tax.
Correct.
Uh,
Correct. That's right, buddy.
Now, I want to hit on this because we're having people ask about it. I want us to talk about the mega backdoor Roth. People who are making a nice income, they they are not able to. And the beauty of the 401k with the Roth provisions is there's no income exclusion, right? That if you're making over, I think it's $236,000, 246,
Yeah.
right? If you're
Very fine
making
joint.
over
That's right.
246, you cannot contribute to a Roth IRA, right? You can't make conventional Roth contributions. There are other ways you could go about it. Backdoor Roth. I think we've done a video on that. But this mega backdoor Roth, let's talk through that a little bit, Nick. How can people take advantage of the ability to really save a substantial amount of money in this amazing savings vehicle known as the Roth IRA?
Yeah. So first, I would say that, that generally owner only solo K, where it's just the one owner or possibly two owners or an owner and the spouse. This is where it's a no-brainer, right? So what this mega backdoor Roth strategy allows you to do is to first fund your employee 401k limit. So say they're, age 50 or older, it's that 31,000 employee limit. And then once they've done that, they can start doing what's called after-tax voluntary employee contributions. So it's not Roth, but it is an after-tax source.
So real quick on that, just to clarify, once you've reached that limit, you lose the ability for any other dollars above that limit to be deductible, right? Tax deductible. So just to clarify, you can still keep putting more money in because you have this larger limit we all call the 415 limit, which is the limit of all dollars that go into a 401k plan, whether it's employee contributions or employer contributions.
Yeah, that's right.
So once you've gone over the deferral limit, you can keep putting money in, but it can't be deductible on
Correct.
in terms of salary deferral. So you're
Yeah,
talking about that number being what you're now targeting as after tax dollars that go in.
that's right. So,
Yeah.
to do that in say in this example, a solo 401k, you just have to make sure your plan document allows for it, or most would allow for it by default, right? Like ours does. But that gives you a path to fund that after-tax voluntary source. And then from there, you have a couple options. Again, your plan would have to allow for this in-plan Roth conversion, where you can, once you fund that, you essentially fund it and then immediately convert it to Roth inside the plan. So that's part of the mega backdoor Roth strategy. And then, some financial advisors, professionals, want that money to immediately be rolled out into an
Right. So
IRA.
when you say in-plan conversion, you mean it's after-tax bucket, you move it into the Roth bucket, but still within the 401k plan.
Correct. Yep.
Or the other
And
is rolling it out to a Roth IRA that's separately outside of your 401k.
yep. Yep.
Yep.
So, um, yeah, you could do either or, right? And so, um, the thing that a lot of you'll see this in a lot of the big publications, like, are you taking advantage of mega backdoor Roth? And one thing that kind of gets forgotten sometimes is that by doing this, it triggers non-discrimination testing for that retirement plan. And so naturally, when you have just, a plan that covers the owner only, there's no non-discrimination to be had because there's no employees, to worry about for testing. So it's a great fit again for owner-only plans. The second you start, you're talking to a company that has multiple employees who are not owners, and are not necessarily on that highly compensated threshold. Um, they're subject to non-discrimination testing, what's called the ACP test. And even if you're playing safe harbor, generally safe harbor will buy you a pass on non-discrimination testing, but it doesn't buy you a pass on testing for this mega backdoor Roth, or the after-tax voluntary part. So what happens, the business owners can afford to do it, but generally the employees cannot, and so you fail testing, and then the owner's got to give all that money back. So in order for it to work for a company with multiple employees who are not owners, it's got to be the right fit, generally a higher paid group who can afford to do this. Otherwise, you're going to fail that test.
Most of the
Sure.
time, right? Again, you're talking about either a very small business owner only, so somebody who's a consultant or somewhere along those lines, uh, or a professional group, physicians, maybe attorneys, where the the contribution percentage that goes in would afford somebody the ability to make those after tax contributions, right? But
Yep.
if you're just a C-suite executive in a Fortune 500 company, what do you think the likelihood is that you would have the ability to do this?
Yeah, that you will see that feature in those plans, but depending on how the testing shakes out, they may or may not be able to take advantage of that. And so, you know, a lot of times you may see like a non-qualified plan designed to help target those folks, where
Correct.
profit sharing and cash balance would be too expensive for that size company.
Yeah.
So
So,
so
but
um so
you would
that's
just end up with return of excess contribution, right? And it
Yep.
shouldn't create any additional tax for the person trying to do it because they were making after tax contributions anyway.
Right. Right. They're just get to receive
Mhm.
that money back.
But it also speaks to the fact that, yeah, while people are out there, reading various things, articles they come across, and like you mentioned, they see this idea of the mega Roth. Um, that doesn't necessarily mean that they can take advantage of such a strategy inside of, let's say, a large 401k plan or a large Fortune 500 company 401k plan, because of some limitations that could kick in, right? So it's not necessarily going to be available for everybody, even as people are out there reading about it all the time.
That's right.
Yeah.
But to
So
the extent that somebody can, right, the Roth is the most powerful savings vehicle that we have.
sure.
Would y'all agree with that?
Yeah, absolutely. Um, this, and I think maybe it's good just to kind of hit on that briefly. I know a lot of these things that we talk about, we take for granted that everybody understands them, I think, oftentimes in our industry. But just to clarify, right? So the Roth IRA or Roth bucket inside of a 401k plan provides people the ability to save money after tax, not pre-tax. So you're not getting deduction for the money that goes into that Roth, either account or bucket. But now it can grow tax-free unless Congress changes the rules, tax-free forever. And then on the back end, when you draw it out, you're drawing it out tax-free as well. And so in contrast to a regular IRA or regular 401k um, tax deductible bucket, where you're putting dollars in pre-tax and then it's growing tax deferred, but all those dollars are all pre-tax, never been taxed before dollars. And so on the back end, Uncle Sam wants to get its pound of flesh. And so hence, when you pull money out of those IRA or regular 401k buckets, you're going to be paying tax on anything that you distribute out as ordinary income. And also, there's the requirement to begin to take required minimum distributions. Now it's 73 on those dollars versus with Roth, you're not going to have to. And so, yeah, I agree, Stephen. It's incredibly within the context of the current tax regime, especially for younger people, but even for middle-aged, really, arguably, socking money away consistently. We all know this, right? The most important, powerful wealth accumulation tool is first, developing the discipline of saving on a regular basis. Second, investing it wisely. And third, allowing the benefit of compounded returns to take over. But then all that on top, the icing on top is when it's all tax-free down the road into the future. So Roth is huge.
That's right. And so, again, as you said, Chad, this mega backdoor Roth strategy, not something that everybody can take advantage of, but for people who want to explore whether or not they can, right? That's if you're a sole proprietor, that's probably you. Yep. If you work for a professional group, physicians group, attorney, something like that, and your employer sponsored plan, it may permit that. It's a little digging with HR. We can try to help you figure that out. Somebody can reach out. We can help you with that to see if you're a candidate to take advantage of that. Nick, I have one question for you here on this Roth thing before we move on, because it is the best savings vehicle that the U.S. government affords us. Do you think that, given the fiscal concerns of the U.S. government, that at some point that they will do away with the Roth provision?
Yeah, we've heard rumors of it for years that some agencies may not be a huge fan of this strategy, but is so far we've heard of nothing that at least I have not recently that anything would be changing. So something we try to keep a pulse on, but you're right. I mean, it could change, and so this is if this is a strategy you can take advantage of it now, I would certainly do so.
You get it while you can, right?
Yeah.
Hopefully, fingers crossed, they never take it away. But the reason that there are limits on who can do it and how much you can save in there lets you know that it is a really good deal for people to take advantage of. And at some point they may say, look, we can't allow any more money to go in there. You pay us tax now and never again. So Nick, talk to us a little bit. Let's move on. We're going to kind of shift more towards talking about some larger plans, corporate plans. But there are a lot of tax credits now that are available for new plans to start up. So if you're a small business owner and you've never started a retirement plan, and there can be some costs associated with doing so, right? If you don't go the simple IRA route, the SEP IRA route, talk to us a little bit about what some of the tax credits that are available under Secure 2.0, what they provide.
Yeah, they're pretty awesome, especially considering how little they were prior to these credits being expanded. So, many years ago that credit was capped at $500 a year for the first 3 years, which if you're a business owner, I'm not sure that's moving the needle enough to incentivize somebody to do a 401k over a simple IRA or a SEP. Now it's potentially thousands of dollars, and there's multiple components to it. One, every new retirement plan moving forward, from this point moving forward, if you have more than 10 employees, you have to have an automatic enrollment provision as part of your plan. So you get a $500 tax credit for having that component in your plan. Um, there's a startup tax credit for your cost to administer this plan. So as long as you have eligible employees earning under, say, 100,000, you can get up to $250 per eligible employee. And the way the credit works is that you get to deduct 50% of your out-of-pocket expenses for the first few years. So it's, could be thousands of dollars, right? If you have to pay,
Mhm.
$3,000 the first few years to administer that 401k plan, you could get up to half of that back as a dollar for dollar tax credit, which is pretty awesome. Um, One thing that kind of prevents you from being able to take advantage of that is if you have had another qualified retirement plan in the past 3 years. So, say another 401k plan that you shut down, or simple IRA or SEP. So don't
So
understand.
you're not gonna get the credits if you're going from simple currently to then setting up a 401k, correct?
Right, right. And there's
Right.
some nuances there, but that's generally the gist of it. So,
Yeah.
but if this is your first retirement plan, that the benefit is definitely substantial. You also get, say you're going to do a safe harbor match for your employees, right? For anybody that contributes themselves, you're going to agree up to match up to 4% of their compensation. This tax credit for the first 5 years will allow you to get up to $1,000 per employee back as a tax credit. And again, there are some nuances to this. This is really geared towards employers with 50 employees or less. That's who benefit the most from this. Once you go from 51 employees to 100, it starts to grade down, but you still get a credit. It's just not as high of a percentage. And then once you're over 100 employees, you're prevented from doing these tax credits. So
So is there a limit on that total credit amount? Like if I have 49 employees and I'm setting up a new 401k plan with all the provisions that we're talking about, right? All the features that we all want to see in place and the government wants to see in place. So automatic enrollment, safe harbor structure, and we can, by the way, I think we ought to talk about those provisions in a second, what that really means. But anyway, does that mean that I could get up to $1,000 per employee or $49,000, or is there a limit on that?
yeah, that's a great question, Chad. I don't believe there's a limit on that portion. There is a limit on the startup cost part. So any billable out-of-pocket expenses that you pay to your financial advisor, your TPA, for education expenses, whatever, what have you, that is capped at $5,000 a year. And then
Okay, there you go.
the employer contribution tax credit you get on top of that. And then also the automatic enrollment, you get another $500 for that component as well. So what used to be $500, cap is now potentially thousands of dollars over the next, you know, for the foreseeable future of starting that
Yeah.
retirement plan.
So
Uh,
let's talk a little bit about, well, I guess Chad, let's focus in on what you mentioned really quick. And we're talking about things like safe harbor, and that's a provision that most businesses really want, where it excludes them or exempts them from some of this non-discrimination testing, right, Nick? And so on the 401k side, they qualify for that by doing one of two things. The first is um, they can make a non-elective contribution, meaning I'm going to put 3% of somebody's compensation into the 401k plan, whether they contribute anything at all. So they could do 0, I'm still doing 3 for them. They could do 10, I'm still doing 3 for them. Versus the safe harbor match, which is 100% of the first 3 that somebody would put in. So if somebody puts in 2%, of their salary and an employee puts in 2%, as the company, you only have to put in 2. If they put in 3, you put in 3. But up to 5%, so 4 and 5, you match it 50 cents on the dollar. So somebody puts in 4%, 100% of 3, 50% of the next one that they put in. So you do 3.5. But once they get to 5%, you're putting in 4%. So they've got to put in a pound of flesh to get money from you. But if you do one of those two things, then you're exempted from that non-discrimination testing within the 401k.
And with the additional requirement that those dollars, whether they're non-elective or matching, that go in on behalf of the participant, do not have a vesting schedule applied to them. So those dollars are immediately vested to the employee, right, Nick, under the safe harbor provisions.
Yep, that's right. And there is one exception to that,
The
which is pretty
QACA,
cool. The QACA, yep.
Yeah.
The QACA safe harbor match. And that's something we see more than ever now because all of our clients doing startup retirement plans that, have to do that automatic enrollment piece. You can do that QACA safe harbor match, which ends up being a 3.5% match instead of 4. So you save a little bit of money there if you're the business owner, and you can make it richer if you want. You can keep it at 4% or more, but you can get up to a 1 or 2 year vesting schedule with that safe harbor, which is the only time you can get a vesting schedule
Yeah.
with safe harbor. So we see that more than ever, and that's almost become our default plan design for those startup 401ks that have more than 10 employees because they're gonna have to
but
do
it's
the
got to be a
automatic.
new plan, right? You can't convert an existing plan to the QACA. Is that right?
So you could, because it's a safe harbor match, you couldn't convert it mid-year. So say you're the president of ABC company and you really like the sound of this type of safe harbor match, the earliest you could implement it would be January 1st of next year.
But if I've got a safe harbor match, I could convert to the QACA for 2026. Theoretically, I could keep my matching contribution level the same, but there would then be a 2-year vesting schedule on the matching contributions starting for 2026.
Yep. In that one, the caveat is that the vesting schedule is generally based on the original data hire. So folks that have already been there the 2 years, they'd be 100% vested immediate, but it'd be a way for them to capture some of that if they have employee turnover by having that vesting schedule start the following year.
Yeah. So I think just for, again, context for everybody that's listening. So the reason why the safe harbor plan structure has become so popular, almost, I guess we might argue the default in many cases, right, for so many companies now that we see and that we're working with, is because prior to safe harbor, one of the problems with 401k plans was you had, I think as employers, as plan sponsors, you want to offer the benefit in general. That's number one. Number two, you want everybody to participate, to take a vested interest in their own retirement future. But not everybody does so, right? Whether it's not being trained on their own to be automatic savers, or maybe cash flow limitations, or whatever factors contribute. And what in time you started to unfold prior to safe harbor was the highly compensated people that maybe were more able to save started to become limited by their ability to put into the plan because of the other folks that maybe weren't as able to put into the plan, and then plans became, with this discrimination testing, became imbalanced, right?
They were
And then
top heavy.
top heavy plans that skewed toward maybe the highly compensated people or whatever. And so under those testing provisions, they started to quote fail. And then that was when people started getting return of contributions coming back to them at the end of the year. That obviously was no bueno for them, right? So safe harbor pretty much kind of removes that problem. If you implement these safe harbor provisions, the government put forth, I guess, how many years ago was that, Nick? That was a long time ago.
Yeah, long time.
But now, as long as all these rules are followed, those testing requirements are now not applied, right? And so
That's
so
right.
you have this better structure for everybody to be kind of able to participate however they can, and the more highly compensated people or owners can kind of be more free to do what they want to do based on their own financial position to put in as much as they possibly can.
Yeah, they
Yeah.
can max out without fear of return of excess contribution.
Right.
Um, so let's talk a little bit about for these companies that they want to be smart with their corporate dollars. They want to make sure they're providing good benefits to their employees. Uh, and now, again, we talked a little bit about it earlier. That post COVID, companies they want to be smart with their money. They want to do what they can to attract, retain, reward their key employees, and they are trying to use some of these financial the retirement planning tools to be able to do that. Um, Nick, how are they doing that? Um, and then as an add-on question for companies that want to know how do we compare to our peers? And if we want to make sure that we're not way behind in terms of what other companies are offering, so we're staying relevant, how can they go about finding something like that out?
Yeah, it's a great question, and it's something that we have those types of conversations more probably with our audited clients. Retirement plans that have 100 balances and up, and so maybe they're trying to decide to safe harbor match still makes sense. Do we want the commitment of having to do safe harbor year in year out? Is it worth that benefit for those precious corporate dollars, like you were saying, Stephen? And so there's a couple of things you could do there. One, you could look at whoever your competition is for hiring the same talent. You can go and pull the 5500 tax form that is public data for those other retirement plans through the EFAST, which is the Department of Labor website, and you can actually pull your competitor's 5500 tax return. And in that audit report down at the bottom, it'll actually state what the eligibility provisions are. Did the company do a match? What type of match it is? So there's a lot of good intel that you can find out. And if you're, one of those companies, then you owe it to yourself to know what your competitors are doing, especially for competitive hiring.
And they could be doing it to you,
Right, absolutely.
right? They
And
could be
they
pulling yours.
absolutely,
Hmm.
especially if you're getting the better of them, they absolutely will. Another thing you can do is there's some cool research that's done out in our industry, and a couple of the fund companies out there will um, provide a complimentary report based on industry or sub-industry. So if you were in manufacturing and you wanted to know that, and you would say you had 250 employees, I want to know what other manufacturing companies of my size are doing as far as eligibility, what type of match, are they doing profit sharing? It even gets as granular as like, hey, do those plans offer loans? Do they offer automatic enrollment? And so that can be a meaningful tool. If you're an HR professional, and this happens a lot where you will be talking to an HR manager who just joined a company, and he or she's like, "Hey, I'm trying to convince the board to go to a safe harbor match. What information can I use to educate the board as far as what our competitors are doing? Because I know they're offering this." And pulling that 5500 or pulling one of those industry reports can be meaningful tools in that exercise.
Yeah. So I tell you, we've been talking a lot about plan design up to this point. I think we probably ought to flesh out a little bit more about, the kind of the extreme version of plan design, which we referred to in the beginning, looking at the diagram that Stephen showed of 401k, going from kind of graduating up to 401k, and then going beyond that to inclusion of profit sharing, and then even going beyond that to potentially inclusion of cash balance, and what that really means in terms of providing the ability for certain employees to sock away even more money beyond these IRS imposed limits, um, and why that may be beneficial for certain companies to explore. To your point, Stephen, about staying competitive. Like, so for example, with certain firms that where highly compensated professionals or whomever, make a lot of fortunate to make a lot of money, a lot of W-2 income, but they're needing to really sock away more and more because they're going to get otherwise hit by taxes. We ought to talk about that, I think, a little bit more just in terms of structurally. But then I think we also let's not forget to talk about now that you have the plan structure set up within the plan itself. There's a whole lot of responsibility that the plan sponsors have as quote fiduciaries, and that we as these advisors to the plans have as fiduciaries, and how much of a serious issue that is, from the perspective of both the IRS and Department of Labor, and what that means. What is best practices fiduciary responsibility look like inside of a plan, or, as we review a plan, and all the nuts and bolts of the plan itself.
Yeah. Well, if we back up and we talk a little bit about as you're dealing with more highly compensated individuals within corporate retirement plans, whether it's the business owner, we're talking about key executives, key personnel. That's where your plan design and your consultation with an advisor. This isn't something that Nick mentioned, like the 401k in a box, or something
Right.
that you're necessarily going to get through a payroll company. No offense to the payroll companies out there, but their competency is doing payroll, and they may have the ability to have you establish a retirement vehicle, but you need a consultation with an advisor or professional that understands the way that all these plans work together.
Yep.
Because we want to try to help you shelter as much money as possible, but also use that knowing that if you're going to take advantage of some of these plans, and if you're a business owner who wants to be able to shelter hundreds of thousands of dollars for yourself, that there are some things that you're going to be required to do for your employees, right? And then that's where it's kind of hard to talk about just in a podcast outside of maybe examining a hypothetical situation, but we want to make sure that you have a plan design that's helping you meet your objectives of tax shelter, whatever HR objectives you have in terms of, I'm trying to retain this individual right here. I want to provide these benefits to this individual right here. And we also need to help you stay compliant, right? Those are the things that we're going to help you do. And again, we want to be the officials in the background. The game needs to be playing over here without a problem, right? You don't need to know that we're there because there's an issue going on. But as far as the fiduciary stuff is concerned, Chad, one of the things that we do all the time for companies is these benchmark reviews of their retirement plans. And we want to compare where they are right now, whatever retirement plan they're currently using, and understand from a fiduciary perspective, what liability do they have as the plan trustee?
Right.
What can they do to outsource that fiduciary responsibility to an advisor, to a TPA, like ERISA services? And then, we want to examine the investment availability. What's the menu look like? What type of participant services are there? We're evolving back to we have a retirement crisis in this country.
Mm-hmm.
And
right.
We've gone from a pension world to now, the pensions are largely dead. Unless you've been a a public employee, government employee, something like that. Um, and the onus of saving for retirement is largely fallen on the individual. And we recognize where there are shortcomings there. Um, and so now there's going to be much more of a focus going forward, or there should be, on what's the retirement readiness of the participants in these plans. And what
Right.
are we doing to prepare our employees to get to retirement?
Yeah.
And and a lot of that is around education. You need advisors that are going to come alongside those employees and help them understand, what saving some money today has the ability to turn into them as far as replacing their income when they retire. So we need that assistance, that educational assistance. Um, if they need to talk to somebody, who do they call? Do they get an 800 number? Do they have an advisor locally that works with that plan? And then from the company's perspective, when they're trying to grade all this, they want to boil it down to, what is the cost of my plan? And we want to examine, what does the 401k record keeper, what do they charge for their services? What's my advisor cost? What's my cost for my TPA? What are the investments within my 401k plan cost? That's going to give me the total cost of my plan. And that's something that for us, as a standard operating procedure, every 3 to 5 years, we
Hmm.
want to evaluate. Uh, Chad, I know we've had a handful just in the last several months of businesses that we've come in contact with where they set their 401k plan up a
Yep.
number of years ago.
Yeah. They get
They
busy. They
Yeah,
just get
and
in
they
cruise
did it
control
in kind
mode.
of a turnkey fashion. They just
Yep.
needed something simple to get started with, and they got that. And uh, fast forward, they've got a couple $1 million in the plan, but they're still paying the expenses as if their plan was brand new,
Right.
right? Because those companies, they don't come back and say, you're still paying us as if your plan had $20,000 in it. It's like the phone company back in the day wasn't going to call you and say you're still paying, $1.99 a minute for long distance, right? And we can do better for
I'm
you.
surprised you remember that back. You're a young
Buddy, I
buck.
got a lot of gray hair now. I got a lot of gray hair now. But uh, the onus is on the trustee, or really, in our opinion, the advisor. We need to come back and we need to be evaluating this for the benefit of the participant. Because as you hit on earlier, Chad, the Department of Labor, if they audit a plan, these are the things that they're going to be asking
Yep.
a trustee. They're going to ask them questions about the expenses in their plan. They're going to be asking them questions about, talk to me about your process and how you do your investment monitoring and review.
Yep.
And they're fairly straightforward questions that could be very simple to answer, but uh, it may not come as a very simple answer to somebody who actually receives that question unless they have an advisor that is engaged with them in that process. So, again, our job there is to try to have their plan be functional and focused on the objectives that they need to have happen, but also to keep them clean, keep them compliant.
Yeah.
That if
So,
they face those questions, they already know that there's an answer in place.
yeah, along those lines, Nick, I'm curious, how often do you come across plan sponsors who don't have a real, I guess, a grasp on the level of responsibility or even liability that they actually have as the trustees of the plan or as the fiduciaries of their plan? Is that common?
Yeah, I would say too often. Yeah.
Yeah.
Yeah. The instances you all brought up of, hey, we set up our plan a few years ago and And unfortunately, a lot of the things we're seeing today with new clients is, hey, our current service providers are not providing timely service, responsiveness. We're kind of not getting what we pay for. So, Stephen keeps mentioning post-COVID, and that's unfortunately a trend that we still continue to see almost getting worse, right? So making sure you have the right advisor team, the right service providers around you, um, who have a stake in making sure your plan and company are successful.
Well, so along those lines, I guess just to kind of like raise awareness, there's a lot, and I know you see this, and maybe you could speak to it, but there's a growing trend, has been for a number of years, but a growing trend in litigation being brought against plan sponsors um, for breach of their fiduciary responsibilities. And it can come in, like I was reading an article recently about even in the form of um, when there are dollars that remain in the plan, right? When somebody leaves and there's, let's like back to the vesting schedule thing, right? So when someone leaves the plan and they've not been fully vested, those dollars remain in the plan, right? In the form of there's a blank. Help me out here. Dollars that are
A
remaining in the plan.
forfeiture?
Forfeiture. Thank you.
Forfeiture.
The word slipped my mind. But anyway, the forfeiture dollars that remain in a plan, there are options that the plan trustees have for what to do with those. And those may be specified by the plan document, or by their investment policy statement. But there's even now litigation that's arisen that where, like, you could say, hey, we're going to use the forfeiture dollars for offsetting future employer contributions or for directing toward plan costs, et cetera, et cetera. And rather than just kind of reallocating to the other participants. And there's now a growing trend in litigation against that for them choosing to, even though it may be in the purview, maybe, allowable within the plan document to let this happen, but to use those forfeitures to offset against future employer contributions. So it's like everything that could possibly arise as an item to go against from a litigation standpoint is definitely on the rise. And so I think it's just kind of like important to educate plan sponsors in their responsibility and how. But that doesn't mean that, like, oh my gosh, we're constantly at risk of being sued. It's just simply, and Steve and I have been talking about this recently, all these things really can be adequately addressed through procedures and process and due diligence and documentation thereof, right?
Absolutely. That's key.
So
Awesome. Hey, well, I think we can wrap it up right there. We've touched on a lot of stuff today. We've talked about things like plan design, ways that business owners can look to increase their tax shelter capabilities, certainly after they've taken advantage of optimizing their Section 199A qualified business income deduction. We talked about some of the tax credits that are available for new plans. We've talked about ways that companies can try to be smart about ways to use their retirement plan to help them with their HR initiatives. And then we've talked about some of the fiduciary responsibilities that these plan trustees need to be aware of. And ultimately, if people have questions and they want to examine what they're doing, they know that they can always reach out to us here at Reveille, info@reveillewealth.com, and we'd be happy to have an exploratory discussion with them. But we'll put a bow on it there for today. So, Nick, thank you so much for taking the time to come on with us and unpacking the subject matter. Chad, thanks for being here as always. Thanks everybody out there for tuning in, and we will see you right here on Bugle Notes next time. Take care, everybody.